All right, time for this week's Fiscal Focus, brought to you by InfoChoice, your choice of information on Australian consumer finance. Now, just over 2 hours ago, the RBA made the widely expected decision to hold the cash rate at 4.35%. But some slight changes in the wording of their announcement has caused a bit of a stir in the financial and economic community. Joining us to tell us more is the Bank of Queensland's Chief Economist, Peter Munckton. Hi, Peter. Welcome to the Savings Tip Jar.
Hello, Dom, and I appreciate the invite to come along and speak today.
No worries, Peter. Thanks for joining us. So, just broadly, what did you make of the announcement to hold? Anything out of the ordinary from Michelle Bullock, the governor? And what did you make of any, slight changes in the wording?
Yeah, Harrison, I think there's some meetings that the RBA meet, and there's a lot of things happening. Today, in one respect, wasn't one of them. As Dom correctly pointed out, there was no expectation that the rates would change. Rates didn't change. If you actually look through the statement that they always release post the meeting, it was virtually exactly the same before, apart from one small change. And this is what financial markets did react to. And if you like, before the meeting, the overall perception that the RBA was giving was that, if anything, the next move in interest rates would be more likely to be up. And that was the case because inflation for much of the last year or so has been well and truly above 4%. And they were worried that if that was the case, if I'm going to change interest rates, it's more likely to be up. Now, the last inflation reading was somewhere in the threes. The unemployment rate has picked up. And so the small change in the statement post the meeting was taking out the reference that we might have to increase interest rates. In other words, what the perception they were trying to give people is that from here, interest rates could go up, but they could also go down. And because of that thing, it could go down. Financial markets then said, well, maybe the next move could be down maybe a little bit earlier than we thought, A, and then B, maybe the interest rate reductions we thought could happen this year, maybe there could be a little bit more than that. So that was basically the financial market reaction post the RBA meeting today.
So, Peter, would you say that, with those slight wording changes, this means it's more likely we have seen the last hike in this cycle?
I think that is the case. I think it's not so much obviously the word changes confirm that, but to me the big was that they keep talking about narrow paths, right? And the narrow path is, can we get inflation down without having to increase the unemployment rate a lot? So that's basically the narrow path that they want to walk. And basically, when the inflation rate was 8, that path looked really narrow. And then about 6 months after that, it was 6. It's still a narrow path. By the end of last year, it was 4, and all of a sudden that path looked a bit wider. And now we are 3 months later on, and the most recent inflation rate we've got is somewhere in the mid-3s. All of a sudden that path looks a little bit wider again, right? So that whole confidence that they should have that they can actually get inflation down without increasing the unemployment rate a lot, that confidence has increased, hence those change in statements. So look, I think it's right. I think that it's more probable than not that we've seen the last rate rise. And in fact, I think it's unlikely rates will go up from here. And then financial markets, as they did post the meeting, are turning their mind to, well, given we're not likely to increase rates anymore, when is going to be the first rate a cut? And when they cut rates, how much might rates actually fall by?
For sure. And a bit of a different one slightly. We hear so much and a lot of the press sort of like narrative is driven from Sydney and Melbourne. Do you think, with Bank of Queensland being a Queensland-based bank, that the residents up in Queensland and in other states that aren't New South Wales and Victoria, do you reckon their experience and reaction and sensitivity to interest rate movements or lack of movements is different? Or is it kind of all of Australia experiences it the same way?
Yeah, Harrison, I think it's an interesting question because you're 100% right. A lot of the media is based in Sydney, Melbourne, financial markets. The big centres are there, so that's where a lot of the talk does come from. And certainly in places particularly like Sydney, just the huge amount of debt that people have to have because of how high house prices are does mean that people are very much focused. But if we look at, for example, in Queensland, sort of since the start of COVID. Prices have gone up, house prices have gone up well under 50%. Right? So, and that's the case not only in Queensland. You go down to Adelaide, everyone's talking house prices. The biggest increase in house prices by city last year was Perth. Hobart had a massive increase in house prices up the last couple of years. So every city, major place you go to, is exactly the same. House prices have gone up a lot. A bunch of people have had to take some debt to actually fund that. And so therefore, a lot of people are very interested in the question of what does this mean for my mortgage?
And Peter, you mentioned how it's more likely that the next move will be a cut. We have seen, the economists at the big four banks come out with their predictions on when that first cut might happen. I think we've got CBA and CBA and Westpac, are expecting the first one to come in September, and then ANZ and NAB expecting November. What about yourself? What's your pick?
I'm not quite sure what the September stuff's about. Maybe it's the football finals that's got the Westpac and CBA focused on September. If I was going to sort of say, if I was going to go which month in the third quarter, I'd be more an August person than September. Look, I'm in November, but if I was going to sort of say what's the risks versus a November move, is it more likely to be August or February 25? I'm more a February 25 person. And really, the reason for that is a lot of the stuff that Michelle Bullock, the RBA governor, spoke about today, which is just basically, look, inflation has come down very quickly, but essentially how inflation's moved in Australia has been very similar to how inflation's moved overseas. And what we have seen in other countries, which is about 6 months ahead of us, what we have seen is that last step down from 3 to 3.5% inflation, the last step down to the 2s has been a harder step. Right, it's just been harder just to get that inflation to slow that last step down. And because that last step down globally has been hard to get through, I think it's likely to be the case here. If you actually ask businesses how they're seeing about things, they're talking about costs still being well and truly higher than usual. They're talking about price rises being higher than usual, and all that suggests that the last step down for us is also likely to be a bit hard. So for all those reasons, I'm at November. But if I was going to sort of say where the risk from November, I think it's more likely to be later than earlier.
Now, Peter, quarterly inflation doesn't come out, or like the data isn't released publicly until I think April for this quarter, and we've already seen a couple of upside surprises in the US, which inflation was higher there than anticipated, although it is generally tracking down. What do you make of this, and will this flow on to this sort of Aussie experience?
Yeah, it's an interesting question, Harrison. And look, and I think this highlights, there's a couple of things. First of all, what we're seeing, not only inflation numbers, but things like retail sales, amongst other things, is that around the start of the year, there's been all sorts of changes in spending patterns and so forth. We're seeing the case in jobs numbers also. So there's a little bit more noise in the numbers around this time of year. So that's the first point we should take into account. But the second one was just the point Dom and I were discussing. And what we've seen in the US is that the numbers were coming down, as you touched on, but also the last couple of months have gone back up a little bit higher than what we thought. So a bit lower, a bit higher. And what that just means is the last step down is harder to achieve. And so I think that's the lesson that we'll probably have here. The US is about 6 months ahead of us on the inflation path. And so the fact that they went down very quickly, we've done that too. But that last step down to where they want to be, they're finding that hard to get through, a bit harder than certainly most of the trip so far. And I think that'll be the lesson for our journey, our inflation journey, is that we'll get down to the low 3s pretty quick. We'll be there in the first half of 2024. But that last step in the low 3s to somewhere in the 2s, which is probably where we need to be to see those rate cuts, that last step down, that'll take a little bit harder, that'll take a little bit longer, and that's why, as I mentioned with my answer to Dom, it's more likely to be a November, maybe February reduction in interest rates than an earlier one.
It's kind of like weight loss, I guess. The last kilo is the hardest.
I wouldn't know,
Harrison. Thank you, Harrison. Now, Peter, inflation and wage growth are often just somewhat related. One seems to drive the other and vice versa. And it seems like in her statements, Michelle Bullock is hinting that, in the RBA's view, that wage growth has peaked. In your view, do you think that's the case?
I think it is, Dom. I think it is like, if we think about what drives and what has driven particularly wages growth this time around, I think you're 100% right. The main reason we've got the strongest wages growth in 15 years is that we've had the highest inflation rate in 30. And we've also had the lowest unemployment rate in 50. So there's been a big demand for workers. Workers want compensation for the higher inflation. So lo and behold, we've got the highest wages growth in 15 years. Now, what have we seen over the last 6-12 months? The unemployment rate, which was 3.5%, is now about 4%. The inflation rate, which was 8%, is now somewhere in the high 3s. And so all that sort of says fundamentally that wages growth should be starting to peak, if not come down a little bit. And if you look at the last number from the ABS, it said if you look at the private sector, and of course it's the private sector which is going to be most sensitive to developments in the economy, if you look at the private sector number, it does look like the wages growth has peaked. And there are other data releases. Seek, which is a job ads company, they put out data on wages, and that is also pretty consistent with a peaking of wages growth. So I think it's fair to say that wages growth has peaked. You know, the RBA has also said, look, given where wages growth is, it's not really scary for us, providing the productivity numbers are going higher, and they are going higher, probably not high enough, right? So there's two things we've got to look at. One is wages growth coming down, and is productivity picking up? And I suspect as we go through this year and the next year, we'll see both those trends, come to light.
And just finally, Peter, we'll go back to the RBA meeting itself, and it's kind of changed tack a bit in 2024 with 8 meetings instead of the usual 11. There's a press conference after the statement is published. What do you make of all that and the increased sort of, access to the RBA? Is this a good move, or does this risk kind of the RBA potentially moving or being more sensitive to public opinion and sort of mainstream media commentary?
Oh, look, I think they're always aware of how people think and feel about them. That's been increasingly over the years to become more aware of the sort of feedback, if I use that term, about decisions. They're a very important institution. I think, Harrison, one of your earlier questions was, outside of Sydney and Melbourne, they know that the setting of the cost of finance, interest rates, is a really important decision for the economy, right? So, they're very aware of that. They take that sort of responsibility very seriously. How has the changes gone? Look, I think it's been really good, actually. Two things that really stood out to me. One is the 11 to 8 meetings. I think one of the problems about going every month is, look, how much information we had since last month. It was only, if you work at the RBA, you spend 2 or 3 weeks putting something together, and then a week later on, you've got to start it up again. You just feel like you're on this rat race, and how much different sort of interesting material can you come up with? If you've got 8 weeks, all of a sudden you've got a whole lot more information to deal with, point one. And point two, just from a decision-making standpoint, if you've got longer in between there, all of a sudden you had more of a fresh break. You're coming to the question, very new. So I think that's been a really good change. And I think the other really good change is that, used to be the case that the meeting comes out and you read through the statement and you think, well, I think the word if means this. They've changed the word if. Does this mean something big? And, people would speculate and write commentary on it. Did it really matter? Did it not? Now you can just ask them. You put if in there, does that matter? Right? So I think that fact that, straight after the meeting, that there can be sort of feedback from the RBA in terms of this is what we said, this is confirming what we said, and if you don't understand, ask us a question about what we said. I think that's a really good thing in terms of getting the message across. And also just more generally, a sort of discussion about sort of where the RBA sees things.
Greater transparency can only be a good thing. Peter, we're aware you're on deadline, got to get your economic commentary and analysis out so quickly after the RBA's latest decision. So, we really appreciate your time here on the Savings Tip Jar. Thanks so much for your insights.
Excellent. Thanks, Dom, and thanks, Harrison. I really appreciate you to talk today.